Hey, future investors! So, you've heard about the stock market, and the idea of investing in stocks has piqued your interest. But where do you begin? Don't worry, I've got your back. In this guide, we'll take a deep dive into the world of stock market investing, breaking it down into simple steps that even beginners can follow. Let's turn that curiosity into a solid foundation for your investment journey. First things first, let's understand the basics. Before we jump into the how-tos, let's grasp the basics. Stocks represent ownership in a company. When you buy shares, you become a shareholder, and your success is tied to the company's performance. Prices of stocks fluctuate based on various factors, including company performance, market conditions, and global events. With that being said, let's look at what steps you should take on how to invest in stocks when you do not know where to start. Step 1. Educate yourself. Knowledge is your best friend in the stock market. Start by understanding key terms like stocks, dividends, bull market, and bear market. Read books, follow financial news, and explore reputable financial websites. Consider online courses, webinars, and even YouTube videos that cover the fundamentals of investing. A well-informed investor is a confident investor. Step 2. Set clear goals. What are you investing for? Whether it's saving for a down payment, funding your child's education, or building wealth for retirement, having clear goals will guide your investment decisions. Different goals may require different investment strategies, so be specific about your objectives. For example, if you're investing for a retirement, you might prioritize safer, more stable investments. Step 3. Assess your risk tolerance. Investing involves risks, and it's crucial to understand and accept them. Consider your risk tolerance. How comfortable are you with the possibility of your investment values fluctuating? Generally, younger investors may have a higher risk tolerance, as they have more time to recover from market downturns. Your risk tolerance will influence the types of stocks and investments you choose. Step 4. Start small with a diverse portfolio. Diversification is key to managing risk. Instead of putting all your eggs in one basket, consider building a diversified portfolio with a mix of stocks from different industries. This helps cushion the impact of poor performance in one sector. For example, if tech stocks are booming, but healthcare stocks are down, your overall portfolio impact is balanced. You can achieve diversification through owning multiple individual stocks or by investing in exchange-traded funds, ETFs, that track a broad market index. Step 5. Open a brokerage account. To buy and sell stocks, you'll need a brokerage account. Many online platforms offer user-friendly interfaces, making it easy for beginners to navigate. Popular brokerage platforms include Robinhood, Charles Schwab, and Webull. And right now, if you open a Webull account and fund your account, they are giving out free stocks value up to $3,000. I'll post a link in the description if you want to check that out. But anyway, choose one that aligns with your preferences and offers educational resources for beginners. Most platforms also provide paper trading accounts, allowing you to practice trading without using real money. For example, Webull does offer paper trading account for regular trading and even option trading as well. Step 6. Research and choose stocks. Now comes the exciting part, choosing which stocks to invest in. Start by researching companies you're familiar with or those that align with your interests. Look for strong financials, a history of steady growth, and a competitive edge in their industry. Analyze financial statements, quarterly reports, and company news. Many online platforms provide research tools and analyst recommendations to assist you in making informed decisions. For instance, if you're a tech enthusiast, consider companies like Apple or Google. If you're passionate about sustainable living, explore stocks in renewable energy companies. Step 7. Dollar cost averaging. Timing the market is challenging even for seasoned investors. Instead of trying to predict the perfect entry point, consider employing a strategy called dollar cost averaging. This involves consistently investing a fixed amount of money at regular intervals, regardless of market fluctuations. For example, if you decide to invest $100 every month, you'll buy more shares when prices are low and fewer shares when prices are high. Over time, this strategy helps average out the impact of market volatility. Step 8. Monitor and adjust. Investing is not a set-it-and-forget-it endeavor. Regularly monitor your portfolio's performance and stay informed about the companies you've invested in. Be prepared to make adjustments based on changes in your financial goals, market conditions, or the performance of specific stocks. Set aside time for periodic portfolio reviews to ensure your investments align with your evolving goals and risk tolerance. So there you have it, 8 steps to get your feet wet in the stock market. Remember, it's normal to feel a bit overwhelmed at the beginning, but with time and experience, you'll become more comfortable navigating the markets. Stay informed, set clear goals, and diversify your portfolio to manage risks. Whether you're investing for the long term or exploring short-term opportunities, the key is to start and learn as you go. Happy investing, and may your portfolio grow as you embark on this rewarding financial journey.